The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and welcome to today's webinar. I'm Joe Overby, Senior Editor of Auto Remarketing. In today's webinar, we're going to take a look at the 2017 Manheim Used Car Market Report and learn a lot more from Tom Webb, Chief Economist at Cox Automotive. But before we get started, I want to go over a few housekeeping items for today's webinar. First, make sure you're dialed in using the phone number provided in your communication email or are able to listen through your computer speakers. A note, we are recording today's webinar and will make the recording and presentation available to you as soon as possible. You will be in listen-only mode for this webinar. We will reserve some time after the presentation for Q&A. You can submit your questions at any time through the questions box on the GoToWebinar control panel. If we aren't able to get to your question today, don't worry. We'll forward it to the team at Cox Automotive so they can respond back to you via email. And last, if you have any difficulty during the webinar, please click on the hand icon on the GoToWebinar control panel to alert a member of our webinar team. So, without further ado, let's learn more from the 2017 Manheim Used Car Market Report. Tom Webb, the webinar floor is now all yours.
All right. Thank you, Joe. I like the opportunity to go over the report and give you some updates since we're already 2.5 months into the new year. Fortunately, a lot of the trends that we saw in 2016 and 15 continued so far this year because it really was a pretty good time for the automotive industry, regardless of what segment that you were playing in. And going forward, it certainly looks bright for the remarketing side of the industry. Some of the people holding residual risk might have a little more of a challenging period in the years ahead. But let's get to the reports and what we're going to talk about today. First, I'm just going to run over some of the numbers in terms of wholesale supplies coming from the rental segment, leasing, repossessions, commercial fleet, and dealer consignment. I'll just give you a little summary in terms of the hard numbers, and with your questions, we can determine, how it most impacts you, whether you are a dealer or a consignor. So then a couple of comments about the state of the retail market, which with respect to both new and used has been extremely good. And in the years ahead, it looks like used vehicles will be a more favorable position than the new vehicle side of the market. That's typical for this point in the automotive cycle. And then just a couple comments on economic drivers. I'm really not going to give an economic presentation today. But, the two big things that drive the market are always labor market conditions and credit conditions. And certainly a lot of people have been worried about when the credit cycle is going to turn, so we can look at some of those numbers also. So let's start with a look at the rental industry, and just as a summary background, we all know that the rental industry is a very competitive industry. It's facing some challenges from disruptors, but the industry itself has the ability to do some disruption of its own. Now, with respect to the remarketing side of the business, one of the key trends that we've seen over the past several years, and which has continued to accelerate, is that we have a much wider mix of makes, models, options, and colors of vehicles entering into the new vehicle rental fleet, and of course, obviously coming out also. And then that final point that we look at is that although the rental car companies in the selling of risk units have been shifting away from the traditional auction channel, it's been very encouraging that has not diminished the product offerings that they're offering in the lanes in terms of quality. So we'll look at some of those numbers. First, with respect to new vehicle sales into rental, last year the number was up about 4%. It was 1.82 million units. As a percent of total new vehicle sales, it was slightly above 10%, which is not all that damaging in terms of future residual values. In the first 2 months of this year, new vehicle sales into rental are actually down 8%, but a lot of that is related to the fact that sales last year were very much front-loaded. I would expect that this year's new vehicle sales into rental will be relatively flat, As a matter of fact, going out several years, I think it'll be relatively flat. We're in this stable environment. So you'll probably be selling 1.8 to 1.9 million new units into the rental fleet every year. And since the rental fleets aren't growing, you're going to have 1.8 to 1.9 million coming out every year. But more importantly is, what kind of units are they going to be? Well, as I said, it's a much more diverse mix of vehicles, more in line with retail customer taste. This shows the share of several manufacturers, the share of their new vehicle sales that went into the rental fleet. Most pronounced there, you can see that General Motors strategically pulled back quite significantly from sales into rental, and actually their share into rental last year was below the industry average, first time that's ever happened. Ford and Fiat Chrysler were relatively stable. If you add the three together, their share of the rental market was the lowest it's ever been in 2016. And as you can see, a lot of that slack was taken up primarily by Nissan, Hyundai, and Kia. So those will be the future units that you see coming back out of the rental market. And with respect to the particular makes and models of those units, again, it's a much more diverse profile of vehicles, one where the option contenting and the retail demand segment is more in line with customers' tastes, so that's going to help protect residual values. In this table here, what I did is I just looked at the number of unique year, make, model, body configurations, which accounted for all the rental risk units sold at our auctions in particular quarters, and you can see it's a pretty large number, 3,352 unique configurations in the third quarter of 2016, but of course you sell a lot of one-offs. I think more telling in terms of protecting residual values and helping dealers find what they need in the lanes. You look at the bottom three rows, for example, the top 10 makes and models accounted for only 16% of all the rental risk sales in the third quarter of 2016, whereas in 2011 it was about 28%. On the bottom line, it took 97 unique configurations to account for 50% of sales in 2016, whereas in 2011 it only required 31 models. And certainly us old-timers will know, if you go back further in time, there was a time when you could basically count 50% of the risks basically on two hands. And unfortunately, they were not trimmed or had the color specifications. They were primarily white that the retail customers want. So the bottom line here is that, you know, if you are a dealer, you're looking for a particular make and model, you're probably going to find it in the rental lanes because, again, it's a wide dispersion of vehicles, especially now since they started putting a lot of the prime sports cars back into the rental fleet. This is the auction pricing for those units, which we've made some adjustment for the broad changes in the mix of vehicles being sold and for the mileage. You can see that last year there was no spring bounce whatsoever. We started off the first 2 months of this year a little bit less than where we were. So again, as a buyer, that's probably a pretty positive thing since when you look at 2014, sure, those prices were extremely high and probably eliminate diminishing your potential gross on the subsequent retail sale. The mileage on the units, you can see two broad periods here. Pre the financial collapse recession, we generally were in the 25,000, 30,000 mile range, and then we bumped up to 35,000, 40,000 mile range. 2015 was driven primarily by one rental car company, which had a lot of older, higher mileage units coming back through the fleet, and we have since returned to normal. We're slightly under 40,000 miles from February of this year back to the summer of last year. And I would sort of expect that it would probably stay in that range. And then with respect to the quality of those vehicles, there was a fear, and rightly so, that as these companies shifted more of their sales to a non-auction channel, the auctions would end up with the poor, higher mileage, poor quality units. That has not proven to be the case. And again, we have a lot rental risk units coming back into the market. It's 42% had a grade of 4.0 or higher in the fourth quarter of last year. So again, a lot of high quality units. I'll briefly switch over to leasing and then maybe have a little break because I don't want to talk to myself for too long. But in terms of leasing, certainly this is a much told story. The new lease originations, they did set a record in 2015, and they have kept growing thereafter. It looks like to me, and I'll show you in a minute, that 2016 will probably be the originations. Off-lease volumes will set a record in this year, and they will keep growing thereafter. I do believe it is a much improved leasing model as opposed to what we had in 1999 to 2002 cycle, which is the last cycle that we had. And again, regardless, the simple increase in volume is going to create a situation where we have higher end-of-term losses on those units, which has an impact on all the players. Obviously, the residual exposure is held primarily by the captive finance companies, but when those end-of-term losses change, it also affects dealers, it affects futures new vehicle sales, and it has lots of other ramifications. But with respect to the numbers, this is a long look at the lease penetration rate. Primarily, you like to look at it relative to retail sales, the red line, but I don't have a consistent series back that far, so I also related it to total new vehicle sales. And you can see, yeah, we are at peak lease penetration rates, no doubt about that, but it is starting to roll over. And if you look at it on a monthly basis, February was actually below where it was in February of last year. It is, in fact, starting to level off because of the increase in new vehicle sales and the increase in the penetration rate. You've had a very significant rise in total number of new vehicles. From about 1.1 million in 2009 at the trough to 4.45 million last year. And again, I think that may play out to be the record because if you look at the trend, in the first quarter of last year, new lease originations were up 16%. In the second quarter, they were up 11%. In the third quarter, they were only up 3%. And in the fourth quarter of last year, they were only up 2%. And now, February year to date, new vehicle lease originations are actually down 4%. So it's very likely that the originations peaked last year, but we will see. Regardless of that, we know that the off-lease volumes will continue to grow and grow relatively significantly, especially in 2017 and 2018, and again, might be getting some leveling off after that period. And in terms of that end-of-term lease portfolio performance, these are estimates by Fitch in terms of the overall portfolios out there. Certainly there's a big difference between who the players are and what segment of the market they're playing in. But sure, end-of-term losses will be the thing of the future. May not be overly troubling, but it will create a situation where you're not going to be able to put together as attractive new vehicle lease deals, which again, as we already saw in the numbers, they're down 4% in the first 2 months of this year. And it probably will help used vehicle values to a certain extent in that a lot of those late model used vehicle sales do not have to compete against a similar new vehicle lease deal, which is overly so dented, because you would assume that they would start to narrow that spread again between their contract residual and the ALG residual. At least one would hope so, because they do have to moderate these losses, again, primarily held by the captive finance companies. And so basically they hold the exposure on about 4 million new vehicle leases that are operating out there. So you think that they would take that into consideration when they develop how hard they want to push the new vehicle side of the market through new lease deals and incentives, etc. But it will be a challenging period for some of those lessors to offload those units. But again, from a dealer standpoint, it's a great quality inventory, and in many instances, that inventory is literally driven to your door by the end-of-term lease customer. And generally speaking, that end-of-term lease customer really wants to be put into a new lease. Most of these lease customers are satisfied. So it's a win situation from the dealer standpoint. The credit side of the market. Certainly there's a lot of talk about the growth in auto loans outstanding, which has been tremendous. But I still believe that the consumers do have the ability to repay those loans, and we'll look at some of the numbers. The longer-term loans, to me, raise some issues. Certainly the repo volumes are going to grow, and they will grow simply because there are more contracts outstanding. That would be regardless of whether we have any significant uptick in the delinquency rates. And then, of course, the auction process is the prime way that repossession vehicles are remarketed, and it does have an efficient arbitration process to getting those repossessed vehicles into the hands of the person who wants them. So it is working well. It's certainly good business for us in the auction industry. Now, with respect to those auto loans outstanding, here are the numbers from the Federal Reserve Board of New York. Tremendous increase in dollar amount outstanding, 58%, $1.1 trillion. And when you look at it, just in this respect by itself, it looks a little scary because we certainly know that household income hasn't increased by 58% over that 5-year period, nor has household wealth. So do people really have the ability to service these auto loans that they have taken out? And the answer is, in fact, yes. They're quite capable of servicing them. If you look at this financial obligation ratio that the Federal Reserve puts out, which looks at a typical household's mortgage, rent, car payment, lease payment, property taxes as a percent of disposable income, you can see it's basically at 40-year lows, which is giving, obviously, the ability to repay these loans. And that looks a little surprising, but behind the story, we know what went on here. Number one, we have record low interest rates. That's a relatively minor factor, however. We also have longer loans on the new car side, which is a relatively minor factor in this ratio also. The big factor here is that through the recession, through the collapse in the housing market, trillions of dollars in mortgages were written off through foreclosures and short sales. So if you look at the actual numbers from the Federal Reserve, actual household debt levels are actually lower than they were at the end of 2008, with mortgages down a whopping $777 million. Home equity loans down about 232 million. Auto loans, of course, are up, and student loans are up. Those are the only categories that are up. They're up significantly. Credit cards are down modestly. So again, if consumers have the ability to repay, generally speaking, they do repay, and especially with respect to autos. It normally sits up there pretty high in the priority list of repayments. And as a result of that, you look at the S&P Auto Credit Default Index, it's basically at historic lows. Now, certainly if you segment it out and you look at some of the deep subprime lenders, who have shown some significant increase in delinquencies as of late, that's to be expected. Some of them bought way down into the space, down into typical buy here, pay here customer space, and now they've had to retrace their steps a little bit. So the market is self-adjusting as it well should. And then, of course, in terms of estimating the number of repays that will be coming back, again, simply because of the higher number of contracts outstanding, even despite the strong portfolio performance, the number of contracts outstanding that have 90-plus day delinquencies, as you can see, increased from about 3 million at the end of 2014 to 4 million today. So you got a million more vehicles out there that are running around 90 days delinquent, which will finally, bleed over into repo volumes, which should probably grow in the neighborhood of 150 to 200,000 per year as we go out. And then finally, on the commercial fleet side of the business, we had a 6% increase in primarily the biggest increase was government last year, but commercial fleet is a bigger segment, as we'll see in a second. The fleet management companies are sensitive to interest rates, and of course, as we found out yesterday, interest rates will be going up, it seems, for a while. And again, the fleet management companies, it should be appreciated the fact that they are strong users of data analysis and best remarketing practices. Some people fail to appreciate this because they sort of assume that since the fleet management companies, for the most part, are not actually holding the residual risk themselves, that they don't have the strongest vested interest, but in fact they really do, and they have been some of the leaders in terms of remarketing vehicles in the auction lanes. The actual numbers here, again, about a 6% increase. It's about 625,000 commercial units. And again, just like the rental side, the overall fleet size are not growing. Actually, they're shrinking a little bit. So if you're selling 625, 650,000 units in, you're going to get that many coming back out every year. Generally speaking, these are lower price, higher mileage units, as you can see here. A fall off in the prices at the end of last year, and a little bit of weakness at the beginning of this year, but again, to be expected. They've been, as you can see, extremely stable. And then again, the mileage on those units, typical mid-sized fleet car coming back generally runs in the 70,000 miles, increased about 5,000 miles over the past 15 years or so. And then on the pickup side, we're generally running about 110,000 miles, which is again is an increase of about 10,000 miles over the past decade. And you do see some volatility in that, depending on when people are pushing units into the new commercial fleet size, or as you can see, that mileage dropped off quite a bit during the recession, and that's because a lot of these companies were defleeting because they no longer had a use for the truck. So the truck has not run its full service life, but they didn't need it anymore, so they were pushing it out of the fleet. With that, I think we can take a break and see if you have any questions on those individual consignor segments.
Very good. Thank you, Tom. We've actually had a few questions come in, and first one kind of goes back to the fleet volume. And the question is, do larger volumes of fleet units negatively impact residual values?
Yes. I mean, again, as they say, all things equal, that higher supply is always going to have a depressing impact on price. Now, in terms of the off-lease units impacting other segments of the market, yes, that occurs too. I mean, we have an industry where there's a waterfall effect. You have to keep the price differential between ages of vehicles and mileages of vehicles relatively consistent. One of the examples I would use is that if you look at the off-lease volumes, people say, well, why would that impact the pricing of an off-rental unit? Well, it affects the dealer's wallet share. I mean, if he's getting an off-lease unit driven to his dealership as a grounding dealer, probably getting a pretty good price at it, he's going to buy that unit, which means he leaves one less other unit, which might have come from the off-rental side. And additionally, I would say this year, if I look at the pricing trends by age of vehicles, the weakest segment has basically been 4-year-old vehicles. The off-lease units have held up well, but they've competed against and put pressure on those 4-year-old units. So yeah, there's a waterfall effect.
Very good. And this is just a reminder, folks, that if you do have a question, please use the question box in your webinar control panel. And another reminder, we are recording this webinar, and we'll make links to this and Tom's presentation as soon as possible after the webinar. Our next question deals with OEM incentives. So Tom, the question here is, to what extent did OEM incentives influence new car prices as well as used car prices of vehicles up to 5 years old? And the second part of that is, what is driving incentives, and and where do you expect them to go?
Well, incentives are obviously extremely high. As a dollar amount, they're at record highs. As a percent of average transaction price, depending on whose measurements you're going to use, they're slightly above 10%, which is not a good situation in terms of protecting residual values. The key question, of course, is, where do we go forward? As I noted, actually, it's still on the website in last month's commentary. There's also the issue of new vehicle inventory that sits on the dealership lot. And in a past life, when I was doing statistical studies in terms of residual values between incentive levels and inventory levels provided a stronger correlation and a better analysis. Now, of course, inventory and incentives are first cousins, if not closer than that. But the inventory level picks up things that the incentive spend does not. It picks up the fact that when the dealer goes into his dealership and has to walk through a sea of new vehicles, and he knows he has an oversupply, and he's having units pushed on him from the manufacturer, his mindset changes, and it's sell new vehicles. Sell new vehicles. It also picks up the fact that when you're heavy inventory, you're going to take units with skinnier grosses. You're going to push. You're going to sacrifice. You're putting your own incentive money, which never gets picked up. So, that's the problem that sits out there. We started this year with about an 80-day supply of new vehicle inventory, 4 million units, made somewhat of a cutback in February, but we're still way, way heavy. There's more work to be done. But again, I'm fairly optimistic and hopeful that this time is going to be a little bit different, and that the manufacturers, again, because they're holding all that residual exposure themselves, that they will not be overly aggressive in terms of pushing the market. But the problem right now today is they have too much inventory, and it's not balanced inventory, as you know. They have too many cars, and in some cases, not enough sport utilities.
Our next question here is kind of an interesting one. It touches on the retail side, but I think it speaks to some of what you were talking to on the rental car side. The question is, the large volumes of fleet unit sales impact new retail sales of the same brand?
Oh yeah, I mean you have that trade-off, if I understand the question correctly. Again, if you are and when you meet with the manufacturers, they know this. I mean, they have remarketing departments where they know that these off-lease units are coming back. They know the model. They know where, and they are trying to protect residual values. So they're pulling all their levers, carrots and sticks to the dealers to buy the units in end of term, maximizing their CBO programs to help support residual values. But at the same time, the new vehicle side is pushing out new vehicle leases with low payments. So to a certain extent, they are competing against themselves. It becomes a relatively schizophrenic environment. But again, it's a balancing act. And I would say to a large extent, they're doing fairly well.
And the staying on the subject of the rental fleet, in terms of disposal volumes, kind of looking at it from a month-by-month basis, do you see the rental fleet disposal prices maintaining kind of where they are now, or do you see them moving directionally, either improving or weakening?
I think the overall market obviously has downward pressure from the simple increase in supplies, so a weakening, but I wouldn't say necessarily a collapse. And again, that is based on a relatively optimistic assumption on what is done on the new vehicle side and pushing it. I mean, because they're one-year-old vehicles, obviously they are more sensitive to the incentive activity and the new vehicle inventory levels than other segments of the market are.
And another reminder here, folks, we are recording this webinar, so if we don't get all your questions in to Tom, we will pass them along to the Cox Automotive team, and and they will share some insights with you. But next question, I wanted to look at, within the auction business itself, the questioner points out that October and November of last year was strong, and then there was some drop off in December, and he wanted to know, has that strong run rate continued into the first quarter of this year?
Oh yeah, in terms of auction volumes, it has continued to grow and will continue to grow. Again, the primary driver is off-lease volumes, and there will be a chart a little bit later that actually shows that. But yeah, it continues to grow, and I think pleasingly in this cycle, even though, and we'll have it the top takeaway here on this one, even though we had that significant increase in commercial consignment, unlike other previous cycles that we've gone through, we didn't really lose the dealer consignment business, which is a good thing.
And Tom, we'll get to one more question before we let you continue on with the presentation. You noted that Nissan, Hyundai, and Kia are increasing rental deliveries. Do you see that this increase will be large enough to impact residuals for the entire segment, or just for these three automakers? For the entire rental segment, that is.
No, not for the entire rental segment. Again, they're doing fairly well with the broad mix of units. Those particular models, especially you look at Hyundai and Kia, they've had shares into rental that high in the past. But what's different this cycle is that they have off-lease volumes too. In earlier cycles, they did not play in the leasing game. So it'll be challenging, but they've handled it well in the past. Well, I guess we'll just wait to see how it turns out. I wouldn't make any projections about specific manufacturers or their models, but again, it is a different environment for them than the past cycle.
Very good. And folks, we're gonna let Tom continue on with his presentation. But again, if you do have questions, please type them into the control panel there on your screen, and we will get to them. Take it away, Tom.
All right, thank you. Yeah, let me just run over a couple of the combined numbers in terms of the auction volumes and where they're coming from, and then just a quick update on the state of the retail market. In terms of the AAA member auction volumes, they haven't reported the 2016 number yet, but it'll probably be close to 10 million units, and maybe just shy of that record in 2003, and it will continue to grow as it goes out from there. If I look at those commercial consignment volumes that I ran through the rental, the lease, and the repos, you can see this is whether it goes through auction or not, and that's a significant increase in volumes, obviously record volumes. You look at 2012, you're a little over 4 million units. You're quickly getting up to about 7.5 million units. So that's a significant increase. And the reason that we sort of focus on these units is because of the simple fact, when you look at it, these are all units that have to be sold, and they will be sold, and then they have to be subsequently retailed, and they have to be subsequently retailed at a profit, which means the only variable that makes everything work is the wholesale transaction price. So you're putting a lot of pressure on that. So it is to a certain extent a challenging environment in terms of protecting residuals. Respect to dealer consignment, as I said, certainly it fell down as a share of total auction volume, but it remains high, which is a good thing, because that remains, always will be, the bedrock of the auction industry. And with respect to where those vehicles are, this is the percent distribution by model year of vehicles. As you can see, that 3 model year past, those are primarily off-lease units, and you can see that significant jump upward. But at the same time, you can see we sell a lot of vehicles that are over 11 model years old. So regardless of what you're looking for, it's a nice spectrum of vehicles. And now if you look at 7 years model past, see that'd be 2009. Obviously it's going down because we didn't sell any new vehicles in 2009, so you can't be selling those used. Finally, a little update on pricing. This is the Manheim Index. It is not a residual percentage. It's going to show an upward drift over time. It's basically at trend level. That shows through February. Since this is the 16th, I tweeted out what the first 15 days of March did. Prices declined. If you look at it relative to some sort of measurement of new vehicle pricing, as you can see we're actually below trend line, as you would expect. But again, there hasn't been really a collapse in pricing yet. And a lot of that is due to the fact that the retail market is strong. These are dealer sales as reported by NADA. You basically had increases of 2% and 3% last year. In the first 2 months of this year, you have increases more like 5% and 7%. So the market is strong. And again, at this point in the automotive cycle, it is very typical for used vehicle sales to show higher percentage increases than do new vehicles. And that's what happened in 2016, and I'd be very surprised if it doesn't happen in 2017 also. If you just look at the 7 publicly traded dealership groups, same-store sales growth, they've been up in 29 out of the past 30 quarters. The gross margins on those sales have started to stabilize, but they are at low levels. And I would expect that we stay at this low level, but we probably don't drop a lot further. As a matter of fact, to a certain extent, as you can see during a recession, sometimes weakness in wholesale pricing actually will help your gross margin. Big economic factors: employment, grown by 14.5 million over the past 6 years, and in the first 2 months of this year, we've shown another increase of 473,000. I expect that the pace of employment growth is actually going to slow a little bit, simply because of where we are in the economic cycle. However, the economy's looking pretty good, actually. Got some big risk, but looking fairly good. So I think instead of what we saw in the earlier years of this recovery, although the actual employment growth might not be as strong, it's going to show up more in wages, which is long overdue. So that should be helpful to the used vehicle buyers. And then finally, with respect to interest rates, those red lines depict when the Fed increased the Fed funds target rate in December of 15, in December of last year, and then, of course, most recently, just yesterday. Last year was obviously unusual. Despite the increase in the targeted federal fund rate, the 10-year Treasury, a market-determined rate, actually went into a summer swoon, went all the way down to a little under 1.4% in July of 2016. That's certainly not going to happen this time around. But the market does seem to be adjusting to these increases in rates, which have been relatively modest. I would not be surprised if the 10-year Treasury puts on a 3 handle sometime this year. But again, totally digestible if the overall global financial markets don't overly react to it. And then finally, just because it's an interesting topic, which a lot of the used car dealers obviously talk about, and you've seen it, it's been an unusual year with respect to tax refunds because the government had to hold those refunds which had an earned income tax credit or an additional child care credit attached to them. And because of that, it was a very unusual flow. We were down 67 in week 3 in terms of year-to-date tax refunds. But there has been a significant, uptick since then, and now we're down about 5% or $9 billion. Or if you look at it on a weekly basis, you can see week 4 ending February the 17th, there was a record $74 billion of money that flew out to customers in terms of their tax refunds. And since technically the government had to hold it to the 15th, basically that came out in 2 days. That's a lot of money to flow in 2 days. And the previous weeks have been a little bit higher. I think the full year number probably comes in a little shy of where it was in earlier years. But if we go back, you can see that in recent years, actually tax refunds have been a little bit lower every year. and I expect that probably will be the case this year. And with that, if you have any additional questions, hopefully you did.
Very good. Well, we've got a few more questions that have come in, Tom, and I'd like to start with this one that looks at the if we're looking at wholesale vehicle sales. Can you speak to some of the trends in terms of percentage share, or even a ballpark figure versus the cars that are sold in lane versus the ones that are sold online, either through multicasting or a pure online model, and then some of the new wholesale digital channels that are out there. Any thoughts on how the share breaks down through those various channels?
Well, in terms of big ballpark numbers, if you look at total wholesale supplies, regardless of whether they go through an auction or not, you're talking a number in the neighborhood of 23 million units a year. And as you can see, that NAAA number totals only 10 million units. Obviously, the significant leakage is obviously in the dealer consignment segment, where there's a tremendous amount of dealer-to-dealer trades, sometimes with a wholesaler involved, sometimes not. Again, as I spoke to the rental risk side of the business, my estimate is about 40% of the rental risk units come through a traditional auction process. Probably 8 years ago, it was as high as 50–55%. So there has been a significant shift there. In terms of the off-lease units, let us ballpark it and say about 50% of the vehicles end up coming through what I would call competitive bid auction process, i.e. it was not bought by the grounding dealer, however you're handling that transaction, and it was not bought by the lessee. That percentage is going to rise a little bit as the volumes grow, and as wholesale values decline a little bit, you'll get a greater share through the auction process, but it's not going to go back to where it was in the old days in 2002, that last off-lease peak where, for some consignors, their return rate was 85–90%. We have a much better end-of-term remarketing process. You're always going to give the grounding dealer an opportunity to buy that vehicle at a, let us say, fair market value. So it doesn't make a lot of sense to not give them fair market value, have the vehicle go to auction and then actually sell even less, because that doesn't help us. And then, of course, I guess the only other segment I didn't mention in terms of volume would be repos, and repos traditionally go through auction. I might put the number at 85%, because we're just saying that those buy here, pay here dealers who take a voluntary repo back in, certainly they retail the unit, they don't take it to auction. But in terms of a traditional lender, you're going to sell the vehicle in an auction process. That's the commercially proper way to do it. Again, us old timers know when you can drive by credit unions and see a car parked out there that they're selling. That's not an advisable practice to do that anymore. So most of those units will come through auction.
And we had a couple of questions that came in on the retail side. First up, the disparity that's between the new vehicle pricing and used car pricing. Is it possible for that to grow even further? And what would potentially turn that disparity around?
Yeah, it's certainly both markets always have been, always will be driven by monthly payment rather than the total cost of the vehicle. But I would suggest that right now used vehicle prices are pretty much in line with new vehicle transaction prices. Maybe I would say that the value proposition is more toward that used vehicle. But people are buying the new vehicle because, number one, obviously they're voting with their wallet that they really do want some of these tech features driver assistance features, etc. And then, of course, the financing terms on the new vehicle side are always a little more favorable in terms of extremely long loans at extremely low rates.
And, you know, some of these large public dealer groups, Penske, AutoNation, increase their focus on the used retail side. Should we anticipate any changes to, you know, the supply and retail competition out there?
It always has been a competitive business, but I think your question is fair that it becomes more competitive. You know, there's a lot of good dealers, franchise dealers, who have always been extremely good used vehicle operators. And I would suggest that the share that are good operators will become even higher in the years ahead by necessity. And certainly a lot of the players realize that is where the opportunity is in terms of making money. So yeah, there's going to be more and more a greater drive for efficiencies that are out there. A lot of them have already been captured, but there are more that reside out there. Certainly, as you know, there's a focus on velocity, turning inventory quickly, and in an environment where used wholesale pricing may become a little more volatile, that becomes even more important. But yeah, a tremendous amount of competition.
Very good. And folks, just to remind you, the voice you're hearing is Tom Webb, Chief Economist at Cox Automotive. Again, I'm Joe Overby, Senior Editor of Auto Remarketing, and we're taking your questions about the 2017 Used Car Market Report. Just a reminder that we're recording today's session, so keep watch in your email inbox for a link to the recording and of Tom's presentation. And if we don't get to your question today, we are passing those along to the Cox Automotive team. Speaking of questions, we're going to go into a finance question here. Many lenders have issued guidance, you know, or have guided increased loan loss provisions in 2016 in the second half as a function of softer dealer sales and some dealers taking on too much leverage. So the question asks, how has this trend played into the first quarter in 2017? Are we seeing an increase in provisions or a more normalized environment?
From the middle part of that question, I think it was, well, I can answer it both ways. I mean, it looked like it was referring to both wholesale financing and retail financing. On the retail financing side, yes, delinquencies have upticked a little bit. The severity of loss has surged quite a bit, and that's not all due to weak used vehicle prices. A lot of that loss was generated when you wrote the loan. If you put an excessive loan-to-value ratio out there, you're going to have a bigger severity of loss. So those have, in fact, moved quite a bit, and I would expect that would continue to be the case. On the wholesale side of the business, yeah, I mean, generally speaking, as you can see in the public reports, generally those losses are incurred by a major loss at one or two dealers, and sometimes more related to the collection and auditing process of the companies. But, you know, that's a good business, and, you know, it's still a very profitable side of the business. The retail side of the business obviously is more interesting in terms of there's a lot of difference of opinion. As you're well aware, people have been talking about a subprime bubble for many a year. Obviously, we're premature, but yeah, there are challenges out there.
And Tom, you know, we can't. I don't think we can do a webinar or a presentation without talking a little bit about political impacts on the auto industry. And you know, this question looks at the you know, any impact. What impact do you see to the automotive industry, on some of the policies of the new presidential administration, whether it's the import tax and, domestic production. And, the president was just in Detroit, the other day, speaking to some of the automotive policies. So where do you see that impacting the auto industry, particularly, on the retail side?
Let me first put it in the broadest perspective possible and not referring to any particular policies, is that there is an opportunity, as I would say in terms of projecting what's going to happen this year, is that you really flatten the bell curve in terms of your expectations. You raise the possibility that we could have significantly higher growth, but you've also to a certain extent raised the possibility that you could have a bad outcome. And net is probably more positive. Certainly from the dealer auto industry standpoint, positives would be something like overall corporate tax reform, not getting into the specifics, deregulation issues, as was mentioned yesterday, a review of CAFE standards. All those would be extremely positive. With respect to some of the particular issues, it's how they play out in the broader scheme of things. For example, a lot of people talk about the border adjustment tax, and they try to analyze it by itself. But in reality, there is not a single person in the world has suggested or supported a border adjustment tax absent overall corporate tax reform. So you have to look at it in its broader perspective. But yeah, there are a lot of issues out there that will impact the industry. But generally speaking, net, it probably increases the possibility of a more positive outcome. But it does increase risk also, I think.
Another question that has come in on the rental car market, and it looks a little bit actually at both the softening of the rental demand at some airports, and then some of the disruption to the rental car business, from folks like Uber and Lyft. With that, do you see the potential for even more rental cars coming back into the wholesale marketplace this year than perhaps anticipated?
Probably not significantly, but to that point, and I did mention earlier, yeah, the first 2 months of this year, the number of rental units coming back to auction has been up significantly, even though new vehicle sales into rental were down. That's because the rental car companies, did have too much fleet last year, and they are rationalizing their fleet. The broader issue, I don't see a lot of growth in terms of rental fleet size. The travel industry not extremely strong in certain segments, especially overseas travel to the U.S. Some disruption, as you say, from Uber and Lyft, although the rental car companies would say that that's been relatively minor and that's not profitable business for them anyway, but I think it has had more of an impact than they're probably willing to admit. But again, they have opportunities too, as you know, to get involved in these areas in terms of renting vehicles to Uber drivers, etc. If you look at the longer term future, and most people say when you get to autonomous cars, etc., you're basically talking about corporate managed fleets, corporate owned fleets, and corporate managed fleets. Well, there are not a lot of people that are better at corporate managing fleets than the rental car companies. So they also have opportunities.
And as a part B to the question on kind of governmental impact, are there any anticipated changes expected related to the CFPB, and how might that, if at all, impact the repo and marketing industry?
I couldn't really address that. I don't, be more of a lawyer's question. I do know obviously there's a very significant probability that the CFPB will in fact be significantly reorganized, or its role will be significantly smaller because there'll be someone ahead of it who doesn't have the same desire to push it where it is going right now, which for the auto industry would obviously be a good thing. But in terms of those repo requirements, et cetera, now that's more of a legal question.
Fair enough. Fair enough. To looking at the off-lease volume that you touched on a couple times, when do you foresee the any price impact to happen, and how much decline might there be?
I just think that the pricing pressure has already started to grow. And there's no doubt about that. In terms of a particular, lessors incurring some significant end-of-term losses, the back half of 2017 could be challenging. 2018 will definitely be challenging. The impact of how big of a loss it's going to be is dependent, number one, on the strength of the retail market, which now remains favorable. If that turns, becomes a little more tepid, then yeah, the end-of-term losses get a lot bigger. And then secondly, and probably the more important factor, is what those same people who are holding the residual risk for the most part, what they do on the new vehicle side in terms of pushing product.
Very good. And continuing on with the off-lease volume, if you look at some of the automakers that have those high lease penetration rates, BMW, Audi, Mercedes, are you going to see them impacted more from the flood of off-lease units coming back?
Well, to an extent, they really have been some of the better remarketer in terms of units, since they've always had high lease penetration rates. They've also always done an extremely good job of keeping end-of-term units within their dealership network. They have strong CPO programs. They do a lot of things right. But the volumes are high, and again, as we mentioned, should have mentioned in response to the last question in terms of those end-of-term losses. As you know, as we say, there's a couple problems in leasing that are inherent. Number one, your peak originations will occur at the top of the economic cycle, which means your peak off-lease values may come back in a less favorable environment and possibly even a recession. The other thing that's sort of inherent is you don't know, how much market tastes have changed over that 3-year period of when you wrote the lease. And in the past 3 years, this consumer preference shift away from mid-sized sedans into compact and mid-sized SUV crossovers has been tremendous. And that's going to get a little bit better, actually. If I look at the number of off-lease volumes that are coming back just in terms of total units, I think 3 of the top 5 in the coming year are actually small crossovers. Probably the Escape, the CR-V, and the RAV4. Which right now the customers' taste and preference for is still good. So it's starting to change a little bit, but that certainly hurt last year because if you're getting an off-lease mid-size sedan, even if it's a luxury entry-level sedan, consumers really wanted the crossovers.
Good deal. Well, that very insightful answer there, Tom, and appreciate all the time that you've given us today. We are just about out of time, folks, and you've been listening to Tom Webb, the Chief Economist at Cox Automotive. Look for more for Tom, as well as news and trends in the used car space arriving daily through autoremarketing.com. Tom, again, thank you for your insights today, and everyone who attended, thank you for listening. Again, if we didn't get to your question today, don't worry, we're going to forward it to the Cox Automotive team. This will wrap up today's session. Thanks to all. For Tom, I'm Joe Overby, and thank you for joining us.
Thank you.